Blue Chip Bulletin. Financial market updates and insights.
Let's talk about Broadcom, because they just dropped a monster quarter with record revenue and absolutely explosive AI growth. But here's the twist. The stock's been going down. So today, we're going to dig into this Wall Street paradox and figure out what it all means for investors. Okay, let's just jump right in with the headline number. For its first quarter, Broadcom didn't just beat what the analysts were expecting, they completely blew it out of the water, posting a record-breaking $19.3 billion in revenue. So what's the engine behind this incredible performance? Well, it's all about one thing: artificial intelligence. Revenue from Broadcom's AI business literally more than doubled, rocketing up a jaw-dropping 106% from last year. I mean, this is the kind of hypergrowth that's really reshaping the entire tech world. And all that revenue, it turned straight into a mountain of cash. The company generated a massive $8 billion in free cash flow in just 3 months. And, that's a metric we really care about, because it's the actual cash the company has left to pour back into the business, pay off debt, or give back to shareholders. Okay, so you see numbers like this, and you'd expect the stock to be just soaring, right? But that's not what's happening. Despite these absolutely stellar results, Broadcom stock has really been struggling this year. So here's our game plan. We're going to unpack these record results and why investors are hesitating. We'll dive deep into that AI growth engine and, the other parts of the business. Then we'll tackle the big questions around margins and risk, see how Broadcom stacks up against its rivals, and then wrap it all up with a final verdict. All right, first up, let's look at the big picture. These incredible headline results versus the market's, pretty lukewarm reaction. This is really the heart of the whole story. I mean, just look at these key metrics. The growth is just undeniable. Revenue, earnings, cash flow, everything saw huge double-digit growth compared to last year. They beat analyst expectations on every single front. These are the kinds of numbers that should send a stock to the moon. But here's the paradox in black and white. This amazing quarter comes right after the stock had a monster 49% run-up in 2025. This year, though, it's cooled off a lot, dropping about 9%. And understanding this disconnect between the business and the stock price is exactly what we're here to do. Okay, let's pop the hood and look at the engine room. How exactly is Broadcom's AI business putting up these just incredible numbers? Because this is the part of the story that has everyone's attention. Now, to put this into perspective, management pointed to a truly stunning trajectory. Broadcom's AI revenue has exploded by more than 10 times in just the last 11 quarters. Think about that. This isn't some flash in the pan. It's a tidal wave of demand that shows zero signs of slowing down. And this chart just says it all, doesn't it? It shows that acceleration perfectly. In a single year, AI revenue more than doubled, jumping from around $4 billion to a forecast crushing $8.4 billion. This is the AI revolution in action. Now, here's the really crucial point. This isn't just about what happened last quarter. Right now, the company is sitting on a $73 billion backlog for its AI products. That's booked business, ready to be delivered over the next year and a half. That gives them incredible visibility into their future. And you don't have to take my word for it. The CEO himself, Hock Tan, said it plainly. He said the demand is completely unprecedented and that he thinks this massive backlog could get even bigger as companies just race to build out their AI capabilities. But, Broadcom isn't only an AI chip company. It has two other really big segments that tell a completely different story: its infrastructure software business and its non-AI chip business. So if we look at the revenue mix, you can see here that semiconductors, that includes both the hot AI chips and the not-so-hot other ones, make up about 2/3 of the business. And then infrastructure software, which is mostly that huge VMware acquisition, makes up the other third. And here, you can really see this tale of two businesses. While AI chips are just booming, the non-AI business, which goes into things like enterprise networking and storage, well, it's recovering way more slowly. It seems like companies are pouring all their money into AI, and it's leaving less for everything else. Meanwhile, you've got the VMware software business, which is kind of like the steady workhorse. Their new platform is designed to give big companies a real alternative to the public cloud, letting them build their own powerful private clouds. And for Broadcom, that means a stable, high-margin, recurring revenue stream. Okay, this rapid shift towards AI, as exciting as it is, brings us right to the #1 concern for investors, the main reason for that stock cooldown we saw. And that's the impact on profit margins and other risks. So first, a quick refresher on gross margin. It's a really important number. It basically tells us how profitable a company's products are before you factor in things like R&D or marketing. Simple rule, higher is always better. And this slide, this gets right to the heart of the problem. Look at this. Broadcom's software business is insanely profitable. We're talking 93% gross margins. But its custom AI hardware, even though it brings in huge revenue, has much lower margins. So as AI becomes a bigger and bigger piece of the pie, it actually pulls the company's average margin down. And that is what's making investors nervous. But management has a pretty powerful counterargument. They basically say that the sheer volume of AI sales will more than make up for the lower percentage. In other words, who cares if you make a little less profit on each chip if you're selling so many more of them that your total profit in dollars keeps growing like crazy? So with this whole margin debate swirling around, how does Broadcom actually stack up against its biggest competitor in AI, the undisputed champion, Nvidia? Let's take a look at the competitive landscape. Okay, when we put Broadcom head-to-head with Nvidia, things get really interesting. Nvidia's balance sheet is just so much stronger, way less debt, and it generates almost 4 times more free cash flow. But here's the real kicker. Even though it's the darling of the AI world, Nvidia actually trades at a lower forward PE multiple. That means, technically, it's cheaper than Broadcom. All right, let's bring it all home. We've looked at the record results, the AI engine, the margin risk, the competition. So what's the final verdict for someone thinking about Broadcom for the long haul? Well, despite all the risks we've just talked about, it is crystal clear that Wall Street is overwhelmingly bullish. Out of all the analysts covering the stock, 29 rate it a buy. Only 1 says hold, and there are 0 sell ratings. That's a huge vote of confidence. So it really all comes down to balancing these two sides. The bull case is all about that massive multi-year backlog and Broadcom's absolute dominance in both custom AI chips and the networking that stitches it all together. The bear case, it's all about that margin pressure, the heavy debt, and some really fierce competition. So what's the bottom line here? Look, for long-term growth investors, Broadcom is a compelling story, but it's a complicated one. The worries about profit margins are real, but they might be overshadowing the fact that this company has cemented its position as the essential plumbing for the entire AI revolution. That massive backlog gives them a clear runway for growth. The stock might be choppy in the short term, but its long-term role as a key architect of our AI future looks incredibly strong.